Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Sei-wan, professor of economics at Ewha Womans University. Professor Kim, good afternoon. Thank you for coming on today.
Good afternoon, Devin.
Well, let's start on Wall Street, where there was another big rally on Tuesday. Stocks closing around 3% higher, continuing on from the previous session's gain of about 2.5%. For the S&P, this is actually the biggest two-day rally since March of 2020. What's the story in the global markets?
U.S. stock jumped again on Tuesday, extending a strong start to the fourth quarter and giving a relief to investors after weeks of punishing losses. The Dow Jones Industrial Average advanced 2.8%. Combined with Monday's rally, it was the best two-day performance for the blue chip index since April 2020. The S&P 500 surged 3.1%, its best day in the more than 4 months. The tech-heavy Nasdaq Composite climbed 3.3%. The market rise was driven by new data from the Labor Department showed that the U.S. job opening fell by 10% in August, and layoffs rose slightly. That signs that the labor market is starting to cool down. While bad news for workers, such a slowdown could help reduce inflation and ease pressure on the Fed to keep lifting rates. On Monday, another closely watched report showed that growth in U.S. manufacturing weakened to its lowest level in more than 2 years. Major Asian markets were mixed today. Tokyo's Nikkei 225 gained 0.5%, and Hong Kong's Hang Seng Index also rose 5.9%. But Shanghai Index lost 0.6% as of 3 p.m. in Seoul time.
Well, now, Korean stocks started out strongly higher today, but those gains were quickly erased. The KOSPI still holding on to that 2,200 level with a moderate increase. And with the dollar index coming down significantly the past few days, we see the exchange rate coming down a little bit more as well. Tell us about the domestic market.
Even with U.S. markets big rise over 2 straight days, domestic markets were mixed today. Moderate inflation of September released this morning did not support domestic market either. Domestic investors became more cautious on continuous net sales by foreign investors and continuing interest rate hikes central banks. The benchmark KOSPI advanced 0.3% today, but cost stocks lead 1.6%. In KOSPI market, individual investors and foreign investors together net bought stocks up to 531 billion won, which is larger than the average net buy. Most of top 20 large cap stocks were also mixed today. Samsung Electronics rose 1.5%, and LG Energy Solution also rose 5.5% today. But Samsung Biologics lost 0.5%, and Hyundai Motor also dropped 1.4% today.
Well, now, consumer prices in Korea rose last month by 5.6% compared to a year earlier. That's a little more slowly than in August. It's the second month in a row now the pace of inflation's slowed down. Daily necessities, though, like food, clothing, and housing, were up 6.5% on year. What do you see happening with inflation?
It looks that Korean price level is passing through its peak over the last 2 years in September and October. Korean consumer prices grew at a slower pace on year for the second consecutive month in September on the back of slowed growth in oil price and agricultural products prices. However, there are still other signs that high inflation might be continued, like higher oil price and $1 exchange rate. Consumer prices, a key gauge of inflation, rose 5.6% in last month from a year earlier, slowing from a 5.7% rise in August. In July, actually, consumer prices increased at the fastest pace in almost 24 years at 6.3%. The inflation or the growth rate of the consumer prices narrowed due to the slowed increase in price of oil and agricultural products, such as vegetables and fruits. However, it is needed to closely monitor the impact of possible cutback of the supply of the OPEC Plus on the global oil prices.
Right. Well, Professor, we'll have to leave it there for today. We're up against the clock. Thank you, as always, for coming on the program. Really appreciate your insights.
Thank you very much, Devin.